excited to have all of you here. And as I said before, we hope's not a very good strategy, but we still hope that you have a lot of fun when you come on this show. You learn something. We love the Q&A and all the questions you ask. And for me, that's the best part, because it really gives us insight as to how we're going to move ourselves forward, get whatever it is in our businesses we want to have done, and educate our children. So we are so excited and so fortunate to have Kathy Scalzo with us. She is going to talk about being the bank. What I love about being the bank is the double dipping. And I'm sure Kathy will talk about double dipping. Yeah, well, if you have your money working for you twice, the same money working at the same time twice. I mean, how could you do better than that? So Kathy, thank you very much for coming on today. And thank you for the last minute saying yes. We really appreciate it. Take it away.
Anytime. Thanks for having me. Yeah, so like Peggy said, I teach real estate investors how to utilize the infinite banking concept to double dip. Like, you can save your money in the bank and then take it out to make your investment, or you can create your own private bank and leverage the money to make your investments with, while your money is still in your private bank earning uninterrupted compounding interest, and it's growing tax-free. As long as you access it correctly. As loans, it's all tax-free. The death benefit is tax-free. The death benefit is just a cherry on top. I'm going to go ahead and just talk about some objections right away to try to open your mind first, because people will say, well, why wouldn't I just buy term and invest a difference? Term is so much cheaper. Yes, the premium on term is very low compared to whole life, but at the end of the day, when you live past the term, all that money you put into that policy is gone forever. Whereas in whole life, it's just in addition to your savings component. So you have insurance for the rest of your life, and you actually get all the money back plus all the growth. So it actually ends up being cheaper than term. And people say, whole life is a terrible place to put my money. I want to make more money in real estate or on the stock market or whatever it is. This is not an either or conversation. Whole life insurance is not an investment. It is simply a storage tank for your money. So it's just changing where you're putting your money first. So you put your money there and then you invest. So you get to earn the money in two places at the same time. So think of it as like another property. Like you have a house, you build equity in your house, and then you can borrow against your house. You take a HELOC. So the life insurance policy is exactly the same. You're building equity in the policy and you borrow against it. The difference is with the home, like you're building equity regardless. You know, even if you take the money out, the equity is building the same. With the whole life, you borrow the money out, you get to make money on that money, and you get to make money in the policy at the same time with that same money. So I want to show you, I'm going to share my screen and just show you an example of a couple of different illustrations, because a lot of people believe that you have to have a lot of money to do this. It's only for the wealthy, but I want to show you that it's not just for the wealthy. The first one is, if you have a big lump sum, and then I'm going to show you if you don't have a big lump sum. Let's see. Can you see my screen?
Yes.
That's not the one I want to start with, though. This is it. So you see all these numbers here on the screen?
Yep. Can you make it a little bigger? There you go. Is that good for everyone? I can't see you to see if you're shaking your head yes.
Okay, so this is an example of somebody starting out with $100,000 lump sum. Like maybe they have $100,000, saved up, ready to make an investment, but instead they put the money in the whole life insurance policy first. So it's the $100,000 jump start and then $50,000 a year of premium deposit. So at the end of the first year, they put $150,000 in, and they have $130,000 available to them to make their investment. And people might argue, but I don't have full access to my cash. I lost $20,000. Well, you didn't actually lose $20,000 because you instantly created generational wealth of over $2.3 million. So you could, save it in the bank, put it directly in your investment and, earn money on your investment, or you can put it here first and, have $2.3 million of generational wealth. Plus your money is growing here tax-free. So although you don't have access to 100% of it immediately, it doesn't take that long until you do. So let's see, look at like year 3, you put in 50,000 and you immediately have an extra $49,800 available to you. Year 4, you put in 50,000, you immediately have an extra $52,000 available to you. So as years go on, you just keep getting more and more money. So this is the non-guaranteed rate that's based on the dividends right now. The dividends are the lowest they've ever been in history because the interest rates have been so low. Dividend rates tend to rise with interest rates. So these numbers will likely be even higher in the future, I'm guessing. These numbers on this side is the guaranteed rate. So the policy is contractually guaranteed to increase in value every single year. You're never, ever, ever going to lose money aside from the cost of insurance that you put in up front. But with compounding interest, you're basically getting all of that back. So that's somebody that already has a bunch of money. Now this is somebody that doesn't have a bunch of money. This is just $6,000 a year, so $500 a month. Yeah, it's going to take some time before you build up enough, to invest in real estate, but not really, because like year 3, you've already built up $14,000 of cash value that you can turn around and borrow against to invest in your real estate. And it's, remember, this is going to be growing as if you never touched it with the uninterrupted tax-free growth. So you're going to be earning in 2 places at the same time. Yes, the death benefit is a lot smaller because the premium is smaller. So just wanted to show you that, you can start small. And then as you build up your wealth, maybe you increase your income, increase your assets, you can always start new policies. So you can start small and just build up. Like some people have 25, 30 different policies. So,
Wow.
and then this is an example of using the policy for loans. This is showing for a car purchase, but this can be for anything. Basically, take the $25,000 and invest it in one of Peggy and her team's amazing opportunities that they have. So you can double your money in 3 years with her and also grow your money here. So this is showing somebody paying a deposit of $10,000 a year for only 7 years. Then they don't pay any more after that. I would never recommend stopping because the more you put in, the more you're going to make, but you can stop. So this is just $10,000 for 7 years. And then they buy a car after 3 years. So they borrow the cash out to buy the car, and then they pay themselves back just like they would any other financial institution. So most Americans are going to be buying a car every 5 years anyways. So the money is going to be spent regardless, but this way you get to keep the money inside the policy in your family forever. So you're paying the money back, and then you basically are recapturing a lot of the money that you spent on the car. So you put in like year 7 here, you put in a total of 70,000 in premiums. Then you bought your car and you paid yourself back, but you still have 67,000 available in cash value for something else. So, the more you use it, then the more it grows, the more your wealth grows. So these are just example numbers. These aren't necessarily exact numbers. This is just to try to get the concept across to you. So
And how long
I'm
can
just
you
going to
keep
show
paying
you.
on that? You said you could stop.
You can pay. Yeah, you can stop paying at any given time. Usually, like we say 7 years to be on the safe side to make sure you have enough to call it reduced paid up. But you can continue paying. You can set it up to pay your whole life or 30 years, or there's many, many different ways we can do it to make your money work most efficiently.
And you're not overfunded, and you're not in a position where you wouldn't get that money at your death, or you wouldn't get it, obviously, but
right. If you don't pay back the loan, then the death benefit will be reduced by the amount of the loan. And another objection people have is like, why would I put my money there? Because they keep the cash value if I die. Well, the cash value is actually the death benefit minus future premiums. So it is a portion of the death benefit. But I mean, if you look, like, okay, say you die, year 5, your cash value was what, $336,000. Let's just say they keep that. Well, your death benefit is still $2.7 million. So does it really matter if they kept that, if that were really the case? And then another objection people have is like, it's just all about the commissions. The insurance agent just wants all those commissions. So I'm not going to do that. Well, these policies are specially designed to minimize the commissions because we design them special to decrease the death benefit. So more of the premium is going towards cash accumulation. See, a typical whole life insurance policy, like year 1 and 2, these numbers are going to be 0. But since we designed the policy special to decrease our commissions and decrease the death benefit, you have more access to your cash. And then another thing is, like, people say they don't want to do it because the commissions are too high, but yet they'll put their money in the bank earning like 0.05%. And the bank turns around and loans their money out, earning an average of 500 to 1,300% return. But it's okay to put your money in the bank, but don't let an insurance agent earn any commission, right? Because that's not okay. So to me, it makes more sense to put your money wherever it's going to work most for you, regardless of who else is making money on it. But anyway, so I just want to show you this quick testimonial of this guy 2 years ago. He had nothing, and now he's using the infinite banking concept along with his real estate investing, and he's extremely successful. So please tell me that it's going to play. Just like 2 minutes.
We're in the house over here.
Can you hear it?
Is holding this, or what am I doing?
Yeah. All right. So how many of you guys know Mr. Burr? How many of you guys are following him on TikTok or Instagram? Anybody know Mr. Burr? Put a Burr in the chat box. B-U-R-R, Burr.
I don't know why
If
it's
not,
not.
definitely go over to Instagram and TikTok and follow Devin.
Let me,
Devin,
maybe if I do this. Oh, there we go.
Burr in the house over here.
Is holding this, or what am I doing?
Yeah. All right. So how many of you guys know Mr. Burr? How many of you guys are following him on TikTok or Instagram? Anybody know Mr. Burr? Put a Burr in the chat box. B-U-R-R, Burr. If not, definitely go over to Instagram and TikTok and follow Devin. So Devin is a money mentor on the Money Multiplier team, and Devin has a really cool story. He's a real estate investor and started infinite banking not even 2 years ago, and now you have, what, 9 policies?
Yeah, 9.
So we were talking earlier about, can you have more than one policy on yourself? Well, Devin went in small. He didn't believe it. He said, what you guys are saying sounds great, but I don't believe it. And he started with a small policy. Everything we said was 100% true. And he said, all right, let me do a bigger one. Then started using it for more deals and just started stacking policies. And that's how you build your banking system. But you're right here, Devin. Tell us a little bit about it, if you don't mind.
So you just took the wind out of my sails.
I know,
You told
right?
my whole story. So yeah, guys, 2 years ago, I was in your shoes, basically. I knew nothing about infinite banking, didn't know it existed. Didn't know a thing about life insurance. I was the typical person thinking that I don't need life insurance because I'm young and I'm healthy. I'm thinking I'll get it later in life, which now that I know about it, it's the dumbest advice or thought process you can have, because the younger you are, the less expensive it is. So the longer you wait, it's more expensive to have the insurance portion of what we do. So I learned about this. It sounded incredible. I'm like, this sounds like a cheat code. Like, if this is real, this is the key. This is like cracking the code. And I had people in my ear telling me that's not how it works. Life insurance is a scam. You're going to put your money in there. You're not going to have access to it for 10 years. And I started believing everybody. I thought, Chris Noggle, this guy, he's got to be just some scam artist. I'm going to give him all this money. I was going to start a policy for $125,000, one on me and one for my wife at $150,000. I was going to put 275 grand into policies, and I'm starting to believe everybody that Chris is going to just take that money. I'm going to be screwed. And I was a real estate investor, so that was my capital to go do deals. I couldn't lose that money, so I started small. I did a small policy, $6,000. 2 days later, I got out. It was like $5,100 of that. I lent it to someone at 15% interest. They're paying me on the 5,100, but my 6,000 was still compounding in the policy. When I saw that was real, 2 more policies, one for 125 on me, one for 150 on the wife. We started those within like a month. Since then, I've just used them to grow my real estate business. I buy all my deals. I get creative on how I structure them. And then I started using them for everything else. Bought 2 cars, a jet ski, wine cellar in our house, landscaping in our backyard, my daughter's braces. I use it for everything, because anything you buy, if you use a policy, you can get all the money back for it. And then you still have the thing. If it's a car, you get all the money back for the car and you have the car. You could then sell it and make money. The wine cellar, I'm gonna get all the money back for it. I still have it in my house. When I sell my house, it raises the value of the house. So it is a financial cheat code. And I want you guys to understand that 2 years ago, I knew nothing about it. Didn't know it existed. And now I'm sitting here today with 9 policies that I use for everything. And I teach people this on a daily basis because it's not difficult. It's just a different way of thinking. Once you change your thought process, it's very, very simple.
It's my favorite thing to say, right? We're not working any harder. We're not working.
Okay. So hopefully that helped give you guys, a more clear example of how it works with real estate, and no reason to just have your money sitting in the bank waiting for the deals, especially now with the, impending recession that people think are coming. People are afraid to invest in anything. They say they're just going to stay liquid. The life insurance policy is the perfect place just to keep your cash safe while you're ready to deploy it. Take advantage of all those deals that are going to be coming in the future. So your money has to reside somewhere, so may as well be in your own private bank.
Private bank. My piggy bank. Yes, Seema.
Kathy, are you part of Chris Doggles group?
Yes, I am. Mhm.
Okay, yeah, because Chris and I are both from Buffalo, and actually the first time I heard this was in Chris's office, because I started my real estate investments through Chris in Buffalo. Now I'm in Florida, and that guy, I keep forgetting, the chiropractor who Chris learned from.
Brent Kessler.
Yes.
Mhm.
He had come and he had talked in Buffalo. That's when I first heard about it. Thanks.
Okay, thank you.
I have a question. Well, I always have a lot of questions. Because I'm so curious. So this gentleman said he had 9 policies. So what is the point of having a whole bunch of policies, or more than one policy, would you say? Does it give you
You
more?
can only put so much money in a policy based on your human life value and your income and different things. So somebody will start with maybe 25% of their income now, and then their income increases. So then they can get more policies on their own life, or they can also own policies on other people that they have insurable interest in, like spouse, kids, business partners. So that's why multiple policies.
Looks like Seema might have another question.
Or she just didn't put her hand down.
No,
Maybe
sorry, I didn't put my hand down. There we go.
Okay. Hey, I just wanted to kind of echo what you said earlier, Kathy. I think right now, if we are indeed going into a recession, I remember back in 2011 when the banks became very restrictive, and it was very difficult to get any type of loan. And if you were able to qualify, the requirements were steep. And if you wanted a credit card, just to get a credit card, it was very difficult to obtain one. And if you did, the limits that they gave you were very low. So, I think what you're suggesting here provides the best opportunity for people to work around the restrictions that would be looming on the horizon, should a deep recession ensue.
Yes, I agree. Thank you, Cliff. Yeah, and the loan, you don't have to qualify for anything. You just tell the insurance company that you want the money, and it's in your account within 3 days generally. So, and then you don't have to pay it back at any given time. It's totally up to you. You can make monthly payments. You can, maybe if you want to buy a property that you're planning on selling in a few years, you can just pay the loan back at that time, or never pay it back, and then it's just deducted from the death benefit. But ideally, you play honest banker with yourself, you pay it back, and then when you pay it back, the money is just available there again for you to use for something else, or another investment, or whatever it is.
So if you borrow a couple $100,000 over the years from it and you don't pay it back and your policy's still worth over $2 million, why pay it back?
Yeah.
You don't have to give it all away.
Right.
But maybe that way you did take it with you. I don't know. One of my favorite movies.
And what?
You Can't Take It With You is one of my favorite
Oh,
movies.
yeah. And some people might say, well, I don't have kids, I don't need a death benefit. But remember, it's not about the death benefit. It's about using it while you're alive to make your money work efficiently for you. And then, give it to charity if you don't have a family you want to leave it to. And then also the death benefit can be accessed early if you were to get chronically or terminally ill. You can use that as to cover long-term care expenses, or take things off your bucket list, or whatever it is.
So I do have a few questions.
Go.
So when you're accessing the funds that are in the policy, are you actually taking the money out of the policy, or are you borrowing against the policy?
You're borrowing against it. So you're using the insurance company's money. It's always more fun to invest with other people's money, not your own.
All right. And and there's benefits of borrowing against it rather than pulling directly out of it, I would imagine.
Right, because if you pull it out, then you're no longer earning the uninterrupted compounding interest. But you do have that option if that's what you wanted to do. But if you pull out more than you have put in, then that money will end up being taxable. If you access it only as loans, then that's how it remains tax-free.
That makes sense. Okay. And then on the interest rate. So I think I heard you say earlier that as the interest rates go up, which is what we're experiencing right now, that the amount that you receive in appreciative interest in the policy will also go up. Is that correct?
If that's the way it's been throughout history, that the dividend rates have risen along with interest rates.
Is there a direct correlation, or is it based on the company?
Yeah, it's based on the company. It's not necessarily directly correlated. It's just that's the way it's been.
All right, and then
because the dividend rate is based on the performance of the company, so it doesn't really have to do with the federal rates.
Right, makes sense. And I'm gonna ask you a question here, a little bit of devil's advocate, but just wondering, and I'm hoping that you can explain. I've been familiar with infinite banking since 2012. Banking on yourself, I've become more familiar with over the last couple of years. The banking on yourself utilizes an indexed universal life versus a whole life policy, which infinite banking utilizes. So what are the advantages of each, and is there a one size fits all, or is there a case where one may be better than the other depending on circumstances?
Yeah, there's definitely never a one size fits all, but in my opinion, well, not just my opinion, but indexed universal life really can't be used for the infinite banking concept because there are no guarantees with that. You do have the potential to run out of money, so you can't really use it with this concept. It may be a good product for somebody that's looking for more growth for retirement because there's more potential for higher returns there, but there's also increasing cost of insurance generally every single year with an indexed universal life, whereas with whole life there's never ever any increase, and you're guaranteed to have your cash value increase every single year, whereas with indexed universal life, because of the increasing fees, increasing costs of insurance, then it can start eating into your cash value. And then I just heard too many stories about insurance agents having to go to their retired clients who are thinking that they're going to have this as their retirement. They're expecting to start their monthly income and to find out that they have, no cash value available. or no cash value in it at all. And then they just say, well, if you want to keep the policy in force, then you're going to have to pay even higher premiums.
And how has the downturn in the stock market overall impacted the IULs?
Well, the IULs are based on the stock market. So you get a portion of the increase in the market. Whereas if the market drops, it's great because you don't lose your money. But, the stock market's going down. I don't see how the IULs are going to be working, in these next few years, because we've been in this bull market for so long, so they've been looking great. So I don't know how they're going to be looking going forward. But I know whole life is going to be staying the same because it's guaranteed, to increase every single year.
I would imagine on the IULs, since the market's been dropped and it's tied, the IULs are tied with the market. Most of them have floors. And let's say a floor is 1%, but the fees are 2.5%. So if they're at floor, they're losing 1.5% on their IUL. And even though on the front end, it looks like a really good deal, but they don't factor in the fees on top of that floor.
Right, exactly.
Yeah.
All right. I'm good on my questions. Thank you.
Yes, I was wondering if when you borrow the money, are you still able to get dividends on it?
If what?
When you borrow money, are you still able to get dividends on it? The borrowed
Yes.
funds?
Yeah, because you're borrowing the insurance company's money against your cash value. So your cash value stays exactly the same, whether you're borrowing against it or not. So your dividend is going to be exactly the same with the companies that we work with. It's called non-direct recognition loan. Like they don't directly recognize that you're taking a loan against it. There are other companies that are direct recognition. The dividends are different based on the money that you have out in a loan. But that's why I like to just work with the non-direct recognition companies where your cash value is the same. It's growing the same whether you're borrowing against it or not.
Yeah. And go ahead, Angela.
What does VUL stand for versus IUL?
That's a variable universal life. So there's more potential for growth and also more risk.
For VUL?
Yes.
But your
because if
product
the market drops, then your cash value drops as well. So you don't have that floor of zero like you do with the index universal life.
Different products and different.
Like I have recently looked at.
To direct some of your fund to, like what you have
I'm
in
sorry?
the policy. Doesn't a VUL give you the ability to choose how some of that's invested, like which stocks you might go into on that?
I believe you do have choice. I'm not 100% familiar with all the ins and outs of the VUL. I just know that, there's more risk with it because you can lose when the market drops. And I've looked at illustrations on a few clients lately, and they show like 3 different scenarios, good, better, best. And, best case scenario, they run out of money. So people like it because there's flexibility in the premium. Like, I have a person right now that she's excited because she only has to pay $100 a month for her death benefit. But in 7 years, the $15,000 that cash value she has is going to be gone. Best case scenario. So.
Any other questions?
But I mean, if you
yeah, I actually have a question myself.
Yeah,
I'm sorry.
Angela. Yeah, I was asking Angela, did you get all your questions? Yeah, go ahead, Alvin.
Okay, sorry about that. I was just curious about the interest rates that would be available to draw the line of credit just based on where the interest rates are right now. I may have missed that before, but what are the typical interest rates, especially in a market like this? And then also, my partner is also on the line here. Him and I have had conversations about being able to start a money market account fund, more or less, so that we would have access to some show me cash basically for some of the deals that we're doing, and also use it as a means to leverage to use for deals as well. So it sounds like this would be a perfect vehicle for that. Can you
Yes.
confirm or deny that? And then also talk to me about the interest rates.
The interest rates are generally between like 4 and 6%, depending on the insurance company. The insurance companies we work with most are 5% right now. So you're paying simple interest on your loan of 5%, and the dividend rates are about 5.2%. Of course, that's before cost of insurance, so on average, over time, it's like 3 to 4%. But if you're not borrowing your full amount, you're not paying interest on as high a number. So you're actually, either way, you're earning more interest than you're paying on a loan, even if you don't have it invested outside the policy. But remember, you're earning more interest in the policy, and you get to earn on the money that you're investing outside the policy. So it really just adds like 2 or 3% extra to whatever it is you're earning outside the policy. And then at the same time, it provides a hedge. Like if you invest in something, the investment goes bad, at least you're still earning that little bit of interest on that money. So it's not as big of a hit.
Okay, that'll make for a better argument with my mentor on that subject then. So thank you.
You're welcome.
Arthur has put in the chat that there are depending on the state you live in, there are different products available. Most major mutual insurance companies work across the US, but offer different products in different states. You have to work with someone like Kathy, who's familiar with your state, who is also knowledgeable on high cash value whole life insurance. Arthur, do you have another comment to make on that? Okay, thank you.
Yes,
For that in the chat.
actually just recently talked to somebody who told me he heard about this concept like 3 years ago and loved it, read the book and everything, but he couldn't find an insurance agent that knew about it. Like every insurance agent he asked didn't know what he was talking about. So this isn't something that just any old insurance agent can do for you, because there's only a handful of companies that offer these types of policies. So I would, there's a very large percentage of insurance agents that don't even know that it exists. So you have to go to somebody that knows what they're doing. That knows, not knows what they're doing, but knows about infinite banking and is specializes in infinite banking.
So real quick, Tyshawn asked, what's the minimum recommended amount to start infinite banking? Gentleman in video invested $6,000.
The minimum amount is about 10 times your age and monthly premium. So say if you're 50, then it would be $500 a month. But you really want to be asking what's the maximum, because it's all about making your money work more efficiently. So you want to put in as much as possible. But you can start with just 10 times your age and monthly. And remember, it's not like, just think of it as a premium deposit rather than a premium payment. It's not like you pay $500 and it's gone. You pay $500 and you immediately have access to like $300 to use for something else. So it's just a pass through for your money, just to make it work more efficiently.
It's a savings account.
Exactly. That still grows even though you use the money.
With a much better rate than what you get at the bank.
The other thing that, Kathy, you haven't really talked about, which of course money is one of my very favorite subjects, and compounding really gets me excited, is this is compounded. You earn, we'll just say 5% a year. You had $10,000, you just earn another $500. Now that's going to earn 5% a year. And every year it's going to keep growing, because that interest then becomes principal. And that principal keeps growing. And that's how you really make money. You cannot get that in a mutual fund. You cannot get that at a bank anymore. When they used to have real savings account, you could get that at the bank. But at the rate compounds going in the bank, shouldn't take you more than 1 million years to double your money.
Yeah.
That would be 5% plus dividends, right?
Dividend?
5% what?
5% interest plus dividend, right? Or is it
No,
5% including dividends?
Total, because the
Total?
minimum guaranteed rate is 2%. So
Oh.
including the dividend, it's like, between 4 to 6%, depending on the company. And
Right.
people will like shop different companies looking for the highest dividend rate, but it doesn't really mean that that's the one that's going to perform the best in the long term, because the dividend rates change every single year. So you want to look at more than just that, one number. It's just
So
just the concept.
yeah, just to be clear, so you get compound interest and you pay simple interest.
Exactly. Mhm.
All right.
Yep. So not only are you making money, you're making more money in the policy, you're also, get to make the money in two places
Mhm.
at the same time.
But you still have to
Multiple
qualify,
places.
right, for the policy.
Yeah, you do have to qualify for the insurance. Somebody comes to your home to do blood tests, urine tests, vital signs, make sure you're healthy enough. And then if for any reason you don't qualify, then you can always use somebody else's life that you have an insurable interest in, and you can be the owner of the policy. So it would be your bank, but it's just someone else's life that's the insured body.
I have a question.
Yes, and
Yeah. I don't understand the compound and simple. So could you explain that? That's my first question a little bit more. And then my second question is, once you qualify for this policy, how soon could you borrow against it?
You can borrow against it within the first 30 days. And simple interest, you'd say it's 5%. You just pay 5% simple interest, period. As long as you pay at least the interest, that's all you have to pay is 5%. Compounding interest, you earn the 5%, and then the next year you're earning interest on top of your principal plus the interest that you earn. So it's compounding on top of each other.
I understand.
So, okay.
are you sure you understand?
Yes.
Good, because that's really the important part. That's the exciting part, the compounding, that it becomes a principal. You didn't have to do anything for it except you didn't even have to leave the money there in this case.
Right.
See, the other thing
Yeah,
is
although
if
you do
did
have the option.
Yeah,
I'm
go ahead.
sorry.
Go ahead.
You don't have to pay the interest if you don't want to, but if you don't pay at least the interest on the loan, then the interest will end up compounding on you. So you don't want to pay compounding interest, you want to earn compounding interest. So ideally you pay at least the interest on the loan every year.
Can I say
Yes,
just,
Alvin.
no, Arthur,
Oh, no, go ahead, Arthur.
just
Oh,
to add one clarification on the calculation of the interest. With the simple interest, as she was mentioning, you pay the interest. It's usually assessed once a year on your anniversary date. Whereas with
Right.
the compounding interest, you can imagine it's just like a credit card. You have a certain amount of days before they add it on. So the mutual insurance companies do not do compounding as would a typical credit card, but that's the difference between simple and compounding interest. One will compound usually monthly, whereas the other one compounds annually.
Oh, that brought up another question, if you don't mind, Alvin.
No,
If
I don't mind.
if I were to set up an account, can I have my payment go from my credit card in every month? Will they take a credit card? Like,
I think you can use your credit card for your first initial premium, but not ongoing premiums.
darn, okay.
But
Just-
there is a service where you can do that.
It's just easier
there?
that you
Oh,
have it set
yeah.
up and you don't have to think about it, because I could set that up and I have my credit cards pay automatically every month, so it's just easy.
Well, you can still set it up automatically through your bank account. And then Arthur said there's a service that you can use to use your credit card
Yeah,
for your
plastic,
premiums.
like
Okay.
plastic, but with a Q at the end.
Okay.
Put that in the chat.
Yeah, I had actually heard about people using it to pay off their credit card debts, and basically you're just transferring the debt over to the account, which is
Yeah.
basically, again, it's simple interest, so you're paying a lot lower payment on the monthly until you can just pay off the whole thing. Along those lines, and Kathy, and by the way, I keep thinking that I met you somewhere before, like at another meeting or something like that. Are you part of the National RIA or something? One of those
No, I
organizations?
know. I think I saw you on Bill Gross's event once.
Okay, that might have been
I'm
it.
part of Inland Empire Real Estate Investment Club.
Okay, that's probably where we met then, because I'm a member of
Oh, okay.
Inland Empire Club too. So, and I just went to the meeting for the first time this year, a couple weeks ago. So,
Oh, at the Mission Inn.
yeah, at the Mission Inn. So
Oh,
it was
okay.
a great
Yeah.
excuse to get out of the house. So, anyway,
Yeah.
back along the lines of what I was talking about before with a money market account, if I'm getting money from multiple investors, my original idea was to basically put it all into a trust and then make, whoever has money into it a beneficiary, weighted obviously with the amount of money that they have. But further, can I get the policy in the name of the trust?
Yes, you can.
Okay.
Great. This is exciting stuff. All you people that are excited.
Oh, this is about the credit card debt. That is a really, really great use of the policy to get out of credit card debt quicker. So we actually have a mapping team. Like once your policy is issued, the mapping team will show you exactly how to use the policy to get rid of your debt. Like it's kind of, to snowball it, they'll show exactly when to take out the policy loans, and they follow up with you every 3 to 4 months to make sure you're getting the best use out of your policy.
Wow,
Great.
it is
Sure.
exciting.
I have a question.
Yes, Fidel.
If I get a policy, let's say on my daughter, and I keep on using it, I mean, what is it? What is the more that I can put into the policy, something like that, and then I can borrow against it. But when can she take over the policy?
At any given time, you can just change ownership into her name, and she can take over the payments.
Is there at some point where you